Welcome to Investments 101, hosted by Burney Wealth Management. We created this video because, well, it's likely that nobody ever taught you about these things in school. Before we get started, let me just say that this video is meant to be educational in nature and does not represent investment advice. As you'll learn today, decisions around what to do with your money should be made in the context of your personal financial situation. Chapter 1. What is investing, and why is it necessary? Investing can be defined in many ways, but in simple terms, we invest when we decide not to spend money today, but instead set it aside with the hope that it will accumulate and grow so that we can afford to pay for our future goals. These future goals can include things like buying a home, traveling the world, upgrading to a luxury car, paying for a college education, or even retiring someday. These goals are unique to us and the life that we want to live. However, one thing in common is that all of these goals cost money. One important thing to consider is that many of our goals have different time horizons, meaning they occur at different dates in the future. Some of these goals are short-term, where they'll happen within the next 3 years. Some are medium-term, meaning they occur in the next 3 to 10 years, and others are long-term, 10 plus years down the road. As you'll see, how we invest and what we might choose to invest in will be impacted by the timing of our goals and the risk we choose to take with our money. Make sense? Let's move on. Chapter 2. What can we invest in? We know that we need to put money aside to pay for our future goals, but what does put money aside actually mean? And if we want this money to grow, what are our options? The investment world can be very confusing, and there are many choices. Let's try and make it simple. The three most basic investment options are cash, bonds, and stocks. We invest in these three categories by opening a certain type of account and depositing money. To invest in cash, we typically open a bank account, and to invest in stocks and bonds, we open a brokerage account. Let's walk through the definition as well as pros and cons for all three categories. Investing in cash is the act of depositing money into a checking, savings, or money market account at a bank. While the money sits there, the bank pays you interest over time. Let's look at how much our money might grow while it is invested in cash. Looking back in history, investors who have held their money at the bank have earned on average about 1 to 3% per year. The rate of interest a bank pays you depends on the economic environment at the time. In a good economy, banks pay higher interest rates, while in a poor economy, the bank might pay you less in interest. Either way, you're earning something. To see how this impacts your savings over time, let's use an example. On the right, we have someone placing $10,000 into a bank account, along with the ending balance after 3, 10, and 20 years, assuming the bank pays 1% in interest each year. As you can see, the money has grown, but not by a whole lot. This is because cash is the most conservative investment, meaning less risk, but less reward. Let's take a look at the pros and cons of investing in cash. The main benefit of investing in cash is that cash balances, up to certain limits, are fully backed by the government and therefore cannot lose value. If you place money in a bank account, the government guarantees that it will be there and that the balance will never drop so long as you don't withdraw the money for spending. The negative of cash is the impact of inflation over time. Ever hear a family member brag about how cheap it was to see a movie back in the day? Or a chart that shows the same hamburger costing 48 cents in 1968 but $5 today? Things just get more expensive over time. Historically speaking, things get about 3% more expensive each year. So if your cash at the bank is only growing at around 2 to 3%, you're not actually earning that much because the cost of living, and most importantly, the cost of funding your goals is getting more expensive each year with inflation. Next, let's talk about bonds. Investing in bonds is the act of lending your hard-earned money to the federal government, state and local government, or a corporation. Corporations and the government oftentimes need money to fund their day-to-day operations, and many times they accomplish this by issuing bonds. For example, the government might need money to build a new school or improve a highway. while a company might need money to expand their operations or launch new products. Bonds allow you to step in and play banker to these institutions so that they can accomplish their objectives, all while you earn interest on your investment. There are four key components to a bond: the principal amount, which is the amount that the company or government would like to borrow from investors; the term, or how long the money will be borrowed for; the interest rate, which is the rate of interest that they will pay you while they use the money that you handed over to them; and lastly, at the end of the term, when the loan ends, the initial investment that you made is returned back to you. Let's use an example to reinforce how bonds work. Say Microsoft wants to develop a new software product and decides to issue bonds, aka borrow money, from investors to pay for the cost of development. You decide to buy one of these bonds, which has the following characteristics: a principal amount of $10,000, which means you hand over your $10,000 to Microsoft today; a term of 5 years, so that the $10,000 will be in the hands of Microsoft and not you for a 5-year period; an interest rate of 5%, meaning Microsoft will pay you $500 a year for the 5 years that they borrow and use your money; and lastly, at the end of the 5-year period, Microsoft will return your $10,000 initial investment back to you. In total, you will have earned $2,500 in interest payments over the 5 years for an annual return of 5%. This is just one example, but thousands of companies issue bonds each year, so you'll need to do some research to see which of these are best for your situation and time horizon. The collective sum of all of these bonds is often known as the bond market in the investment world. Let's take a look at some of the general characteristics of bonds as a whole. Looking back in history, investors who have participated in the bond market have earned, on average, anywhere from 3 to 5% per year. So what does this mean over time? Just like we did with cash, let's use an example of someone investing $10,000 into a basket of different bonds and what the ending balance would be after 3, 10, and 20 years if the annual return was 5%. As you can see, the money has grown, especially compared to the investor who had all their funds in cash. However, in the world of investing, whenever you want a little bit more return, you need to take on a little bit more risk, meaning the risk of losing your initial investment soon becomes a possibility. Let's take a look at the pros and cons of investing in bonds to start to reinforce how this works. The big benefit of investing in bonds is the interest payments you receive over time. A fixed interest payment on a bond greater than what you would have earned at the bank provides a higher return on your investment as you work to achieve your goals. But if bonds provide a greater return, why not just invest all of your money there instead of cash? Just like we learned, if an investment has a higher return, it usually means there's more risk. Looking at the bond market historically, the best year for bond returns was a gain of about 30%, while the worst year for the overall bond market was a loss of about 10%. Why is this important? If you know you need money for your goals in 1 to 2 years, bonds might not make sense if you don't want to risk losing any money you'll need short term. However, if your goal is medium or longer term, you are more likely to capture something closer to the average for bond returns over time, which is somewhere in the neighborhood of 3 to 5%. However, there are two main risks when investing in bonds. The first risk is what we call default risk. A default happens when the lender can no longer afford to make the promised interest payments, or even worse, can't return your principal back. In our prior example, Microsoft would have defaulted if they couldn't pay the $500 in interest one year or couldn't return your $10,000 initial loan. The second risk with bonds is called interest rate risk. What if a year after you bought the Microsoft bond, interest rates had gone up and Microsoft was now offering that same bond for 6% in interest per year instead of 5%? Well, too bad. You still have 4 years left on your 5-year bond, so your money is tied up. What does that mean? It means the bond you're currently holding is worth less because the same alternative can now be bought on the open market for a better interest rate. This is why it's so important to consider the term of a bond as it relates to your time horizon. Bond loans can be as short as 1 year or as long as 20 years, so you can spread your bets across time. Let's move on to our third and final investment option, stocks. Investing in stocks is the act of becoming a partial owner in a corporation. Companies, both large and small, often sell a certain percentage of their business to the public, also known as a public offering, to raise money and allow others to participate in their upside and downside. Unlike bonds, where you are just a lender, stocks give you actual ownership in the entity. Companies like Facebook, Home Depot, Wells Fargo, and Twitter are all examples of companies traded publicly. There are thousands of companies that are traded, and just like bonds, the collective sum is known as the stock market. Repeating the same $10,000 example, let's say that instead of parking it at the bank or buying a bond, we want to use our $10,000 to buy shares of Nike stock and plan to hold that stock for a 10-year period. At the time we buy them, each share of Nike is trading for $100, so we end up with 100 total shares. During trading hours every week, the value of Nike stock will either rise or fall as people buy and sell it based on their opinion of how Nike will perform in the future. Will they continue to make great shoes and merchandise, or will new entrants to the market cause them to lose their competitive edge? Regardless, the shares will be worth something at the end of the 10-year period and will have either gone up or down in value. For example, if Nike did well and the stock price appreciated to $200 a share, your investment will now be worth $20,000 for an annualized return of 7% per year. If the shares of Nike had gone down to $60 a share, your investment will now be worth $6,000 for an annualized loss of 5% per year over the period. This illustrates the fact that stocks have the greatest upside and downside potential of all three investment categories. Looking back in history, investors who have put all of their money into the stock market have earned an average annualized return of 7 to 9% per year. So what does this add up to? Let's use one last example of someone investing $10,000, but this time into a basket of different stocks and what the ending balance would be after 3, 10, and 20 years if their annualized return was 9%. As you can see, the money has grown, especially compared to the investor who had all of their money in cash and bonds. But again, with the higher return that stocks yield comes a higher level of risk. So let's look at the pros and cons of investing in stocks. The benefit of investing in stocks is you get to participate in the actual growth of the companies you own over time. Some of these companies that are doing well even pay dividends, which is like an interest payment on a bond and another added bonus. As we learn, your upside is somewhat limited with cash and bonds, but with stocks, you can do as poorly or as well as the underlying companies you own. Going back historically, the best year for the stock market was a gain of about 50%, while the worst year for stocks was a loss of about 40%. This is the main reason why stocks are the best possible investment choice for long-term goals. They have the widest range of returns in the short term, but the highest long-term upside potential, with an average annualized return of 7 to 9%. The two main risks of stocks are market risk and business risk. All stocks trade on an exchange together, and sometimes their collective prices move up and down in reaction to major world events that have little or nothing to do with the individual companies. Think of 9/11 or the financial crisis, periods of time where everyone was fearful and the prices of mostly all stocks fell together. There are just some events that impact stocks that we have no control over. Business risk is the risk related to the individual companies you choose to invest in. For example, what if Nike had a chemical agent in their shoes that began to make people sick, and therefore everyone sold the stock, causing the price and value of your investment to drop? There are countless examples of individual companies hitting unexpected roadblocks that negatively impacted the stock price. This is why it's so important to spread your bets across different types of companies. This concludes a very preliminary introduction to the world of investing. It was our goal to keep these topics high level as to help build a solid foundation for your future learning and research. For that reason, we are confident that this video left you more knowledgeable, but also with additional questions. Please feel free to reach out to us directly at info@burneywealth.com or tune in to some of our other educational videos.